Currencies, Russell, obviously where it's all happening in Asia right now, specifically in regards to Japan intervening yesterday. I mean, just in a simple question, does it and will it work?
Okay, well, one thing it will work is it will work in that the yen will not go below the Ministry of Japan's target level as long as they're prepared to live with the domestic liquidity implications. They can create an infinite amount of yen if they want to. So to that regard, it works. The more important question is, will it work to reflate Japan if you print a lot of money? And I think many people have question marks on that. But what it really should work to do is this. All around the world, people are making the big inflation or deflation call, and financial markets are riven by this debate. The activities of the Bank of Japan yesterday should make it clear to all across the planet that our future is inflation and not deflation, because the last holdout for deflation, which was Japan, has given up. And the Swiss National Bank is intervening in the foreign exchange market, and there's a very simple question all investors have to ask themselves. If no central banker in the world will let their currency go up, surely we have to devalue against something, and therefore we have to devalue against goods and services, and that's inflation. So the important lesson for the next 5, 6, 7, maybe 10 years from what the Bank of Japan did is prepare for inflation, don't prepare for deflation.
And that means get out of bonds and go into equities, yes?
Absolutely, and particularly in America, where we see an incredible relationship between bonds and equities. If we look at the relationship between the dividend yield and equities, or the earnings yield, which is the inverse of the PE, and bond yields, we're looking at levels of valuation we haven't seen since the 1950s. So there is a once-in-a-generation opportunity, definitely, to get out of bonds. And for the next couple of years at least, we should see pretty good returns from equities. Longer term, there's even issues with equities, because the scale of the bond bear market for the United States could really be one that drags on for decades and not years, and eventually higher yields on bonds impact equities. But when we're starting at such low levels on bond yields, it could take a few years before there are any negative implications for equities.
Russell, wish we had more time, but thanks for joining us today. Russell Napier there, a consultant global strategist at CLSA.